Decentralized finance, or DeFi, is a new digital financial infrastructure that eliminates the need for financial transactions to be approved by a central bank or government agency. Many consider DeFi to be an umbrella name for a new wave of financial services innovation. DeFi is closely linked to the blockchain, the decentralized immutable public ledger on which Bitcoin is built, which allows all computers or nodes in a network to keep a copy of the transaction history. The concept is that no single entity has control over or can change the transaction ledger. The Ethereum network, the second largest cryptocurrency marketplace, also serves as a foundation for other blockchain apps to be developed on it. Two or more parties can swap, lend, borrow, and trade directly using blockchain technology and smart contracts using decentralized apps or dApps without the involvement or costs of a middleman. In theory, it is a fair, free, and open digital marketplace. In practice, at least for the time being, this is not always the case. Hello there, everyone. It is Clever Money here, and today we will go over all you need to know about decentralized finance. Without further ado, let us jump right in. To begin, what distinguishes a DeFi from Bitcoin? While Bitcoin is a decentralized digital currency that runs on its own blockchain and is primarily used as a store of value, DeFi refers to financial services built on public blockchains like Bitcoin and Ethereum that allows users to earn interest or borrow against their cryptocurrency holdings. For example, DeFi encompasses a wide range of financial services uses, including selling, borrowing, loan, and derivatives. So, how does DeFi work? Well, DeFi provides financial services using cryptocurrency and smart contracts, eliminating the need for intermediaries such as guarantors. Lending, where users can lend their cryptocurrency and earn interest in minutes rather than once a month, receiving a loan instantly, making peer to peer trades without a broker, saving cryptocurrency, and earning a higher interest rate than a bank, and buying derivatives such as stock options and future contracts are just a few of these services available. Users employ dApps, which are mostly available on the Ethereum network, to facilitate peer to peer business transactions. Coins like Ether, Polkadot, and Solana, stablecoins whose value is pegged to a currency such as the US dollar, tokens, digital wallets like Coinbase, MetaMask, DeFi mining, as known as liquidity mining, yield farming, staking, trading, and borrowing, lending, and saving using smart contracts are among the more widely used DeFi services and dApps. DeFi is an open source, which means that its protocols and apps are theoretically available for users to examine and improve. As a result, users can create their own dApps by mixing and matching protocols to uncover unique combinations of opportunities. What are smart contracts exactly? So, it is a piece of computer code that serves as a digital contract between two parties. A smart contract is a computer program that runs on a blockchain and is stored in a public database. It cannot be changed. Smart contracts can be sent automatically without the involvement of a third party since the blockchain handles them. Only when all of the terms of the agreement are met does the peer to peer transaction come to an end. Smart contracts have the apparent benefit of allowing you to borrow and lend your cryptocurrencies without the need for a middleman, which eliminates many of the hazards associated with traditional lending. If a borrower fails to meet their loan requirements, for example, their lender can simply take their funds back, eliminating the need for security. Furthermore, DeFi savings accounts might work similarly to bank savings accounts, but with better interest rates or the ability to pay out daily, weekly, or monthly, depending on the platform you are using. So, what can DeFi be used for? As previously said, DeFi provides financial services without the involvement of banks by utilizing cryptocurrency and smart contracts. The possibilities of what you can accomplish with DeFi continue to expand as more dApps are added. Sending money anywhere in the world in a short amount of time and at a low cost, storing money in crypto wallets, and earning higher yields than at a traditional bank, borrowing and lending on a peer to peer basis, trading cryptocurrencies anonymously, and at any time 24/7, trading tokenized versions of investment such as stocks, funds, other financial assets, and non fungible tokens or NFTs, crowdfunding, and buying insurance with the help of companies subsidiaries. So now, how do people profit from DeFi? People are attempting to profit on the growth of a DeFi in a variety of ways. Using Ethereum based lending apps to generate passive income is one option. Users essentially lend their money out and earn interest on the loans. Yield farming is another approach being utilized, which is a riskier practice performed by more skilled traders in which users search through a plethora of DeFi tokens in the hopes of finding prospects for higher returns. But it is a complicated and it is opaque. DeFi, like many other new decentralized blockchain networks trading cryptocurrency, is extremely risky, especially when it is a new technology aimed at disrupting an established institution like a centralized bank. It is even riskier for newcomers who are enticed by the promise of yield farming and passive income. Because there are potentially greater potential threats, Ethereum provides security and scam avoidance standards. Fraud and crime are still a major problem, according to Chain Analysis, a blockchain analytics company. $14 billion in cryptocurrency was sent to illegal addresses in 2021, roughly doubling the amount sent in 2020. In 2021, DeFi protocols were robbed outright for $2.2 billion. According to the investigation, fraudsters made $7.8 billion in cryptocurrency from victims, with $2.8 billion coming from a scam known as rug pulls. Developers construct seemingly respectable cryptocurrency ventures before stealing investor funds and disappearing in these schemes. Many attacks on DeFi exchanges in the last year, according to Chain Analysis, may be linked back to faults in the smart contract code that governs such protocols, which hackers exploit to steal cash. The most important takeaway is to avoid new tokens that have not undergone a code audit, Chain Analysis said. A code audit is a process in which a third-party firm analyzes the code of the smart contract behind a new token or other DeFi project and publicly confirms that the contract's governance rules are ironclad and contain no mechanisms that would allow the developers to steal investors' funds. Guys, that is it for today. And if you learned something from this video, please press the like button and consider subscribing for more great content like this. Thank you all so much for watching, and we hope to see you again in the next one. Take care!